Hey everyone, today I want to do a quick analysis on Sleep Number stock, ticker symbol SNBR. They are a mattress company and they have some pretty interesting metrics on the surface, and I think it's worth a further look. Sleep Number was one of the 3 stocks that was on my watch list in my most recent M1 Finance video. I'll go ahead and link that in the description below if you want to check that out. And it took a bit of a tumble today as I'm filming this video. It was down 5% on the day. We'll see by the time this video releases if it's around the same price. But in this video, I want to look at the fundamentals of Sleep Number as a business, and then also do an intrinsic value calculation on its stock based on a variety of assumptions to see if it might be worth buying. Before I go any further, I have to emphasize that this is not financial advice. Your own assumptions may be very different than my own. You never know what the future is going to hold, yada yada. Please don't take what I say as financial advice. Do your own research. I'm just some guy. But anyways, as of the filming of this video, Sleep Number is sitting at around $76 per share, which puts it at a market cap of about $1.8 billion. The current price is actually closer to its 52-week low than its 52-week high. In fact, it's about half of its 52-week high of $151 per share. So let's see if there's an opportunity here. A basic overview of the business is Sleep Number Corporation, together with its subsidiaries, provides sleep solutions and services in the United States. That is a really fancy way to talk about mattresses. The company designs, manufactures, markets, retails, and services beds, pillows, sheets, and other bedding products under the Sleep Number name. It also offers adjustable bases under the Flex Fit name, temperature balancing products, including dual temp layer, Sleep IQ Kids, K2 beds for kids, man, that's a mouthful, and smart beds under the Sleep Number 360 and 360 names. So basically it's these kind of high-tech sorts of beds with, you can call it sort of an all-in-one solution, I guess. You have temperature controlled mattresses combined with mattresses that can adjust. That's kind of their main brand appeal. At least that's my understanding of Sleep Number. I don't have one myself, but I think their flagship product is a mattress that can move and adjust on both sides, but they're also introducing different technology with Sleep IQ to try and help people get better sleep. And they seem to be doing quite well. The company sells its products directly to consumers through retail, online, phone, and chat, as well as through wholesale. I know they do have a number of retail locations, but they also do make sales online. There are other mattress brands out there that are completely online, so keep that in mind. That might affect margins in the long term if they're focusing on brick and mortar. Sleep Number Corporation was incorporated in 1987 and is headquartered in Minneapolis, Minnesota. All right, so the first thing I always like to look at with a company is the balance sheet. So we go over to financials, go to balance sheet. Let's see what they're working with. Hey guys, real quick, just a reminder to check out the affiliate links in the description below, especially those links for Webull and Robinhood, where you can get some free stocks. I get some free stocks as well, so it's a win-win. Please go check that out. It's free money. You might as well do it.
It's free real estate.
Cash, they have about $4 million, so that is hardly anything compared to their market cap. And let's see what they have by way of debt. I'm looking at their other assets here. I got some $64 million of goodwill on the balance sheet, which isn't really going to do much for you by terms of liquidation value. They do have quite a bit of inventory, $81 million, a lot more than cash. So I guess if they needed to liquidate, this is the accounting basis of it, maybe not the true retail value of their inventory. But anyways, that not much going on the assets front. But what about debt? Let's take a look at what they're working with there. We see that they do have capital leases. This is leases they've capitalized onto their liabilities. So they do owe this money, but they're getting leased store in return. So it's a little bit different than something like a straight up line of credit or something like that. But either way, they do have $283 million in leases that they have to worry about. At least that's how they're accounting for them. They don't seem to have any long-term debts. At least I'm not seeing it accounted here, but they do have other debts. They have accounts payable of $91 million, short-term borrowings of $244 million. I did already mention the capital leases more on the long-term side. So certainly some significant debts, at least compared to their cash position, which basically doesn't exist. That does worry me a bit because not having a ton of cash versus the amount of debt you have does mean that you're at risk for short-term events that might happen. Maybe you lose a lot of cash flow in the short term and all of a sudden you can't pay off your debts or you can't pay down your monthly expenses and all of a sudden you're in big trouble. Not having that safety net of cash does have me a little bit worried, but let's see what they're doing on the cash flow side in a bit. For now, let's also take a look to see what they're doing with their total shares outstanding. And my goodness, this is a share buyback machine. They've basically halved their shares outstanding over the last 5 years. Let's go ahead and look at this graphically. Wow. That is what you like to see as an investor, seeing your ownership in the business passively increase because the business is basically cannibalizing itself in a good way. Now, a business can overpay for itself, what happens when a business buys back its own shares? You'll often hear it called share buybacks. What this means is that this business is buying back its own shares on the open market, which means there are less shares outstanding, which means that the existing shareholders who still have their shares now have a greater share of the business because there are simply less shares of it out there. This is the opposite of share dilution or issuance, where there are now more shares out there and each individual share is worth comparatively less because there are more of them, cutting up the business into more pieces, so each piece is worth less. It can certainly make sense for a business to issue shares if it can reinvest that money more effectively and maybe can get it at a cheaper value, depending on how you want to value the stock, than doing something like debt. That can make sense, but no matter which way you spin it, it's going to dilute shareholders, and that's not going to look good on a earnings per share basis. You're not getting as big of a share of the business. On the flip side, if a company is overpaying for itself via share buybacks, that could be a problem too, because they could be investing that money more effectively into other projects. So you always got to take things with a grain of salt. But in this case, Sleep Number has been buying back a ton of shares. So each individual shareholder now has a greater share of the business simply by the virtue of there being less shares out there. And I'd venture to guess that their lack of cash probably comes from the fact that they've been doing so many share buybacks, and that's where a lot of the cash is going. So let's take a look at their cash flow statement, since this really is the lifeblood of the business. You really want to see cash flow, and in particular free cash flow, growing, because that means that the company is also growing, its profits are growing, and that's exactly what you go into business for. It's to produce profit. And even if a business is growing its revenues in a big way, that doesn't really mean that they're necessarily making a ton of progress if their expenses are also growing. So you do want to take a look at profits and free cash flow to see what's going on with the business, and that's really what your main goal is as a business owner, or in this case as an investor, since you do own a share of the business. And the way you get free cash flow is you take cash from operations minus capital expenditures, and you want to see the blue bar, this cash from operations number, growing at a faster rate than capital expenditures, the dark gray or black bar. And if we go ahead and stretch this out a bit and go back 10 years, we can see that their cash from operations has been growing and their capital expenditures have been largely shrinking if we just kind of look at the longer term trend. Obviously there are exceptions, but you don't see huge volatility from year to year, which is a good thing, except really from this last year where you saw a pretty substantial spike into 2020 into 2021, where the cash from operations grew to all-time highs. Let's actually go to a quarterly view to take a look at some more recent data, since we're nearing the year end for 2021. Here's the quarterly view going back over those last 10 years. We can see that largely things have been pretty steady on the way up. So a massive spike in 2020, and that has come down a bit into 2021, which is still strong, at least historically speaking. It's not as though this was completely a one-off event. It seems that they've been able to maintain a lot of their momentum from before the pandemic, which is a good thing, though you're probably not going to see these numbers anytime soon again, though who knows, we'll see what happens. Going back to the annual view, at least over the last 5 years, it seems like kind of a ballpark free cash flow number is something around $200 million, maybe on the high side. If you kind of assume that this is a bit of an anomaly in 2020 to 2021, you could probably assume something around a $200 million free cash flow number. It may be a bit lower as well, depends on what assumptions you want to make, of course, but that's probably where I'll be making my assumptions before I do deeper research into kind of the stickiness of the customers, since that really does matter as well. You want to see how many people are buying mattresses every 10 years from Sleep Number. After all, they have been around for some time, and you'd also want to see how many friends of current customers are buying these mattresses. How loyal are the customers for Sleep Number? That's going to be very important because this is a pretty competitive space. There are a lot of mattress companies out there. You want to see if they have any sort of customer loyalty, any sort of moat in this space. And if you jump on over to the income statement and take a look at revenues, we can just kind of see the gradual growth of the business. We'll go as far back as we can, 2005. You like to see this nice step ladder up. It means the business is continuing to grow their top line numbers, which is fantastic. Everything flows down from revenue after all. So if you can't grow revenues, it's going to be pretty hard to grow profits unless you can drastically cut expenses, but that's pretty hard to do too. So it usually starts with revenue growth, and they've really maintained quite steady growth over the last decade, especially. If we go ahead and throw revenue growth into a chart, we can see that over the past few years, it really has hovered around that 8 to 10% mark for the most part, and it's been pretty steady, especially since about 2015, where revenue growth has remained around that rate. And looking at gross margins going all the way back to 2005 up to the present day, we can see that they've remained pretty steady around that 60% mark for gross margins. So you haven't seen a lot of compression there, which is great. And that also shows that there is perhaps some room to run here as they they continue to try and gain market share. Currently, Sleep Number is trading for around a 9 price to earnings ratio. This is lower than its 5-year average of closer to 17 or so. So it does seem to be cheap from a historical basis, but then again, they did have that spike in cash flows and spike in earnings over the last year or two. So investors might be discounting that, thinking that they won't be able to maintain that sort of momentum. That could explain the relatively low PE. And on a cash flow basis, they're trading for about 8 times free cash flow, at least based on last year's number of around $225 million in free cash flow. Now, before I do an intrinsic value analysis, I do want to take a look at kind of what the target market here is for the mattress industry. It's not one I'm particularly familiar with, so I want to get kind of a broader overview of what I might expect for a company like Sleep Number if they're to continue to grow. What is a reasonable growth metric? You want to make reasonable assumptions. For example, at least in many cases, you probably don't want to assume that a company is going to grow beyond the total addressable market. So this can be kind of a decent way to see how reasonable your assumptions are. Of course, the market itself could grow too, but let's just take a look at the current US mattress market, since that is where Sleep Number is focused. My understanding is they don't really do international sales. It is very US focused. So let's take a look at the US mattress market, at least according to PS Market Research. It says the US mattress market generated around 16,000 million, so $16 billion in revenue in 2020, and is expected to grow a few percent per year through 2030. So if we assume that's correct and we go back to Sleep Number's revenue of around, we'll call it $2 billion per year, that would mean that they have around a 10 to 12% share of the US mattress market, which is a significant share. So we'll keep that in mind when we pick an appropriate growth rate for our intrinsic value analysis. So if we head on over here to our intrinsic value calculator, which is a discounted cash flow analysis, we can see our inputs here. I'm starting with 9% growth every year for the next 10 years as our kind of baseline case. That's about the rate they've been growing at for the past 5. Maybe they can continue that momentum, maybe not, maybe you disagree, you can change your assumptions. I'm using a discount rate of 15%, meaning that is the required return I'm going for. I want to make sure that I can make around 15% if all of these assumptions are true, and it ends up being worth what I think it's going to be worth using these assumptions. I'm using a terminal value of 14 times free cash flow based on their numbers 10 years from now, or at least what I'm projecting them to be 10 years from now, which is closer to the historical average that a lot of companies see. Typically, multiples will range somewhere between 14 to 16, at least historically speaking. That could always change, of course, but I'm using history as my guide here. You can obviously make your own assumptions. And that's really an average multiple. You might see much higher, you might see much lower, depending on the company, the quality of the company, how much growth are you caking into your projections. Since this is 10 years down the line, I'd be expecting Sleep Number to be a lot more quote unquote mature. So it seems like you'd probably want to be closer to the average than being way above it. But then again, 10 years from now, you might assume that Sleep Number will have more avenues for growth, or otherwise multiples will be really high compared to their historical averages. That's totally up to you to decide. Knock yourself out. I'm using a starting free cash flow of $225 million, which is probably a bit on the high side, but we're using this as the base case. That is their last year's cash flow, which probably is more of a fluke, if anything, but we'll go ahead and use this as the base case. And then we have excess capital, which is really their cash minus their long-term liabilities is what I try to do. So I took basically the leases that they have outstanding and some other things and just estimated around a negative $400 million sort of net worth, I guess, if you will, just looking at long-term liabilities versus their cash. But back to this growth number, remember, we want to use reasonable assumptions. Well, 9% per year is a bit over a double in 10 years. So that would double their current market share of, I said 10 to 12% before. If the market itself stays about the same size, that would imply that they have about a quarter of the market. Maybe that's a lofty assumption, but it's not as though they're taking up 100% of the market all of a sudden and they're drowning out all mattress companies. So I didn't assume that. I'm assuming that they would have double the share that they do now in a best case scenario. But assuming this, they'd probably have closer to say 18 to 20% of the market, since I'd assume the market would be a bit bigger as the economy grows, as there are more people in the world. Maybe they go the international route and they address the global market. But anyways, I think that's a pretty reasonable assumption, assuming, of course, the company itself can actually keep up that 9% clip. So we calculate all these free cash flows, then we discount them by our discount rate. We then take the terminal value of the business, add it all up, and we get a present value of future cash flows of $3.5 billion, which means the intrinsic value based on these numbers would be the 3.54 minus our negative sort of cash balance, if you want to look at it that way. And that makes it $3.14 billion as an intrinsic value sort of target. That's compared to the current market value of about $1.8 billion, which means you have a pretty fat margin of safety. Again, assuming these numbers are true and assuming this actually happens, which is never for a given. So let's go ahead and make some more conservative assumptions. Let's say that their year zero free cash flow is $120 million rather than the $220 million. So we'll use that as the start, and we'll assume maybe they have, 8% growth. They slow down a bit, or even better, they stay at 9 for the first 5, and then they end up at 7 for the latter 5. And then you see, okay, not as great of a deal. You have a negative margin of safety. I guess we would call that a margin of danger of 24%, since the intrinsic value in this case would be less than the current market cap. And I think that's mainly because of those capital leases that they have and their long-term liabilities compared to their basically non-existent cash. However, you do have the buyback tailwind, which might help a lot, but it's hard to assume that. You need the cash to do that. They are throwing off a good amount of cash flow. I'd assume they're going to keep buying more shares in the near future. We'll see how much they keep doing that. But you could also lower the discount rate. Maybe you don't really care about getting a 15% return and you'd be happy with 10. Then it still looks like a pretty good deal. So it totally depends on your assumptions. It's really what I'm getting at here. But you can see there is something here. It seems like, at least if you think that these numbers are accurate and if you assume that anything like this is going to be happening in the future, it might be a very worthy buy. I think I'm going to be opening up a feeler position in the next day or two, depending on where the price goes for Sleep Number, since I think there is something here. But I do want to do some further research, especially on their customer retention numbers, to see how likely customers are to leave Sleep Number after they buy one. Do they have a lot of repeat customers? All that sort of stuff. That's something I would really want to know going into a company like this, especially in an industry where it doesn't seem like there's much of a moat, since anyone can create mattresses. Yes, they have some technology in here that they've spent a lot of time producing, it seems, and that's all well and good, but it's not as though someone else can't just start doing the same thing. It's selling mattresses. It's not selling something particularly complex. So I'd want to make sure that they really have some solid customer loyalty or some sort of advantage there to where they'd have a bit of a moat. But I definitely want to get your guys' thoughts on Sleep Number, especially if you're a customer. Let me know what you guys think of the product. But also, if you're looking at this stock, definitely would love to get your thoughts in the comments below. And if you guys like this video and want to see more stock analyses, then definitely like it, since that would help the channel out a lot. And be sure to subscribe so you don't miss out, since I put out new videos every single week as they have to do with investing and personal finance. And check out the free stuff and the affiliate links in the description below. But until next time, take care.